Hello, Marc Ostwald from ADM Investor Services International, with some thoughts this week on topical issues. First of all, dealing with this whole hoo-ha around the Reddit traders and some of the speculative moves, and then comparing and contrasting the situation in money markets in China and the USA. So my first chart this week is the VIX Volatility Index, and it's really there to serve as a reminder that as much as we did have a lot of excitement at the end of January, it was deemed that by some that the retail market was starting to take control over the overall market and creating a lot of volatility. Actually, it's proved to be somewhat not the case. And really all it proves is it's very easy to create a lot of volatility in illiquid stocks, but bigger market picture is basically still swamped by central bank liquidity, which is basically where I want to move to next. So my first two charts after the VIX are related to China. The first one is the long-term view of what's been happening with the 7-day repo rate in China. And I think it's instructive. Basically, what we've got there is the bands which the People's Bank of China target as upper and lower limits for the 7-day repo rate, or their implied limits. As we can see, throughout most of 2020, the PBOC was extraordinarily generous and ensured that basically the system was flush with liquidity. However, latterly, particularly since the start of the year, even towards the end of last year, when it noticed, when it was concerned above all about some of the defaults in the corporate sector, it started to notice basically there was a little bit too much carry trading going on in its own domestic bond market, and probably largely fueled by the excess liquidity which it pumped into the system, and it started to be less generous. So as we can see on that chart, that resulted in a fairly major spike, almost to the peak. What was unusual about of its band, what was unusual about it is this was just shortly before the Chinese Lunar New Year holiday period, which begins on February the 11th, which is normally a period in which the PBOC injects a lot of liquidity into the system rather than drains it. Nevertheless, the second chart highlights that with a little bit of judicious additions, but still actually net draining liquidity, the PBOC has still managed to squeeze out some of that excess carry trading going on in the Chinese government bond or in the Chinese credit markets, while also maintaining liquidity in the money markets to ensure that there isn't really a major squeeze going on as they come in towards the Lunar New Year period. It probably will have to do some more, but there is a lesson here about squeezing excess liquidity out of financial markets. And there is a very stark contrast, one would have to say, between what's going on in China and indeed what's going on in the US. And this is my fourth chart today. This compares what's been going on with the rates which basically are affected, which are within the band of what the Fed targets for Fed funds. And as one can see, whether it's the 3-month LIBOR rate, whether it's the secured overnight financing rate, whether it's treasury bill rates, these are all trending lower because of the excess liquidity in the system. And the Fed's promise basically to do that. Now, my final chart for today is basically one which refers to what's been done, announced this week in terms of the Treasury's issuance plans for the first quarter of this year, which have been drastically changed. Back in November, they were estimating that they would be borrowing something like $1.1 trillion. Now that's been reduced to just $274 billion. And the bulk of it is going to be as a result of running down the huge cash balance that the Treasury has at the Fed. That injects a lot of money into the system. The Fed, basically this huge balance, which is 1.6 trillion at the moment, is going to come down to 800 billion by the end of Q1 and 500 billion by the end of Q2. That adds a lot of liquidity into the system and still keeps it very flush. And indeed, the lack of issuance from the Treasury, at least during Q1, will basically keep markets very much afloat and looking for opportunities.